Hello, everyone. We'll get started in about one more minute. Hello, everyone. My name is Chris Huntsman. I'm the Supervisor of Internal Sales for One America's hybrid life and annuity LTC options, which a lot of you probably know by the name of Care Solutions. Today, we're going to focus exclusively on the annuity-based options, which we call as a portfolio, we call them Annuity Care. Today's webinar is also being recorded. So one thing I do want to let everyone know is that a link to the recording and a copy of the slides are going to be emailed to all attendees by the end of tomorrow's business day. So if you haven't seen that email by the end of tomorrow, please just email me at chris.huntsman@oneamerica.com and I'll shoot those over to you. But once again, so you should get that email by the end of tomorrow's business day. Once again, it'll have the link to the recording of the webinar. It'll also have a copy of the slides and then a link to the campaign landing page that'll have all the marketing materials that were designed for it. So before we get started, we'll give compliance their moment in the sun here. I'll kind of assume you're all speed readers here. So the first thing I want to touch on before we get into our solutions is the huge potential for sales in the hybrid annuity LTC market. You know, the amount of assets in annuities is huge, and the average age of the annuity owners is right around the average age people typically begin preparing for the risk of long-term care to their retirement plan. Currently, there's just under $2 trillion of deferred annuities on the books, and each year there's around $100 billion in non-qualified deferred annuity sales. So the market is absolutely huge. So from the previous slide, we know there's a huge amount of annuities on the books, and sales each year in the annuities are huge as well. But now the question is, well, what are most of them used for? You know, as a lot of you know, most clients buy annuities due to the tax deferral or due to an attractive income rider they can turn on later in life. But the funny thing is, most clients who own annuities don't really ever intend to turn on an income stream from them. And when surveyed, 73% of annuity owners stated their annuity was earmarked for an emergency in case of a catastrophic illness or need of nursing home care. Because what we all see happen is, you know, I might have put money into this annuity when I was, you know, somewhere between age 50 and 65. I've never needed the income in retirement, so I never turned on an income stream. Now I'm hitting age 70 to 85 range, and I've got this large non-qualified annuity with a lot of gains built up in it. So I don't want to just cash it out and use it for something else because I don't want to pay taxes on all those gains. But I also don't want to give up the asset and turn on an income stream I don't need. So they just end up being earmarked for emergencies is what they end up being. So One America's Annuity Care Solutions are similar to other annuities in a lot of ways. You know, obviously they're going to offer tax deferral for cash purposes, cash value growth, bypass probate, and have an option to annuitize. So at the end of the day, they're still annuities, are hybrid options, so they can still do all the things a normal annuity would do. Now, where they are different is offering tax-free withdrawals for long-term care and the ability to leverage your annuity anywhere from 2 times to an infinite pool for long-term care you can never outlive. And remember, once again, 73% of annuity owners have those funds earmarked for long-term care. So the market is huge for it. It's also an easy conversation to talk, you know, find that 70 to 85-year-old that has a large non-qualified annuity on the books. So if you've sold annuities in the past and you've got a large annuity book of business, that is an absolute huge opportunity to look for that 70 to 85-year-old with a lot of gains built up in it. Just call them up and just ask them, hey, what is this money earmarked for? If they say the word emergency, make sure you make them drill down on what in their mind would constitute an emergency. You know, obviously we're showing you've got about a 73% chance they're going to start to describe a long-term care event. And if that's the case, pretty easy to get them in the door by saying, let me show you a different annuity we can move it to make it tax-free for that exact purpose. I don't know many people that are going to turn down that appointment. So there's a huge opportunity right there. So when it comes to being tax-free for long-term care, that's because of the Pension Protection Act. Now, one thing I want to make sure that's absolutely clear, while two of the options we have on the annuity care line of business, two of them do allow for qualified funds and non-qualified funds, and one of them is non-qualified funds only. Only the non-qualified contracts can be used tax-free for long-term care use thanks to the Pension Protection Act. So the IRS isn't willing to let us use qualified annuities tax-free for long-term care, so they're not fully on board with that part of it yet. Obviously, we'll try and get them there, but for now, it's only non-qualified contracts. So I want to make sure that's clear before we get too far into this on the tax-free withdrawals. So at the end of the day, Pension Protection Act was voted on in 2006, went into effect 2010. What it allowed us to do was refile our original annuity care product that we designed back in 1998 to make it tax-free for LTC withdrawals. But it also allowed us to create two additional options that are also tax-free. So the PPA will apply to all three contracts that we issue here on the annuity care line, as long as they're funded with non-qualified dollars. So where that comes in really handy is I go back to that, that 70 to 85-year-old that has that old annuity with a lot of gains built up in it. So let's say they had this $125,000 annuity, and let's say it started out as a $50,000 cost basis, and now it's got $75,000 gains built up in it. Well, if they use it for that emergency, well, obviously they're going to pay taxes on that, so it's not really worth $125. That might be worth somewhere in the $1 to $110 range, depending on their tax bracket. So you're actually losing money. So not only are you not creating leveraging, but you're actually losing money on the amount of dollars they've got in the contract. Now, instead, what they could do is do a simple 1035 exchange, put that into a PPA eligible annuity with us, and pull all that 125 out tax-free for long-term care. So immediately you've created leveraging just by making it tax-free. And we'll also, later on in the webinar, we'll also show you some additional ways that we can create leveraging as well with riders. Now, one thing that I always want to get in the conversation here, because we run into this a lot, if I'm talking to a husband and wife, a lot of times, as a lot of you know, the annuity is in just one person's name. So while they might be joint owners, it might only have one of them as an annuitant. So I'll use the example, let's say I've got a husband and wife, and the annuity is in the wife's name only. So she's the owner, she's the annuitant. Happens a lot. Well, we do have a way of still making that 1035 exchange like to like and adding on the spouse for coverage as well. So we have something we call an eligible person. So in that scenario, what we would do is we'd 1035 exchange it with her as the owner and annuitant in the new annuity. And then we would list him as what we call that eligible person. That way, even though he's not an owner or an annuitant, he's eligible for the tax-free withdrawals and the LTC coverage as well as her. Now, another thing I always like to point out, any annuitant on the contract has to be insurable. So annuitants are basically the insureds, if you will. And then also the eligible person is an additional insured. It does have to be spousal because we want to make sure, if that owner or annuitant dies, we want to make sure that that spousal rights apply and they can take over ownership with the annuity without having to cash it out. So this is spousal only. Another thing that I always like to point out is this is a huge opportunity if you've got a lot of clients with some old annuities on the books that had those 3% minimum guarantee interest rates. In the past, you haven't been really able to do anything with those. So they're out of surrender and they're just sitting there because all new contracts have somewhere usually between 0 and 1.5% minimum guaranteed interest rates. So from a compliance standpoint or suitability standpoint, that was hard to move and justify. Well, that kind of goes out the window here because at the end of the day, this isn't about an interest rate play. So I always kind of laugh a little bit when someone asks me, what's the interest rate on annuity care? I always like to say it doesn't matter because that's not why you're buying this contract. Now, with that being said, it's got at least a 1% minimum guarantee depending on the contract you're looking at. So it's always got at least a 1% minimum guarantee interest rate on the fixed accounts. And then on our indexing option that we'll talk about later, it's at 0%. But at the end of the day, it's all about turning this money tax-free because remember, this person has this specific use in mind of an emergency. So it's a tax play and a leveraging play. It's not about an interest rate play. So once again, if you start getting hung up in an interest rate conversation with a client, you've got to resell them on that's not why you buy this type of annuity. So whether the interest rate is higher or lower, than the current annuity it's in when you're doing the 1035, doesn't really matter because how much interest would you have to earn for all the leveraging we're going to create and all the tax-free benefits we're going to create? Especially for someone at 7085, they don't have time to wait on the interest rates to make up for the tax, the tax-free withdrawals and the leveraging. So the first option we came out with back in 1998, we just called Annuity Care. Now, a lot of times you'll hear us in the home office and a lot of the marketing organizations will refer to it as Annuity Care 1, just because we've created 2 additional options since. And the idea behind the concept was, especially for those of you that aren't familiar with the concept overall of what we do at One America, we're what we like to call a high deductible catastrophic insurance coverage for long-term care. So the reason we call it that is basically your annuity is going to act like your deductible and you're going to spend that down first. Now, once again, if it's non-qualified, you're going to spend it down tax-free first. But there's also an optional rider that we call a continuation benefits rider that I can add on the back end of the annuity that's going to continue those long-term care benefits for a lifetime benefit. So we can create this infinite pool for long-term care that can never outlive. So really what the rider is a traditional long-term care policy. But you've got to spend down this deductible or this base annuity policy first. So really the annuity is acting kind of like your health savings account, and then the rider is acting like your catastrophic insurance policy. Now you don't have to do lifetime. So if someone just wanted to double their annuity's value on the Annuity Care 1 option, you could just do a rider that mirrors the base policy. So if your base policy was basically $100,000 in your annuity, then the rider could be purchased for an additional $100,000 of coverage. Now, how you pay for the rider is either with an annual premium out of pocket, so you'd be writing a check each year to One America and sending it off for the rider, or you're doing a lump sum, all in one lump sum to pay for the rider. Now, if you do a lump sum to pay for the rider, it can be part of the 1035 exchange as well. So in theory, if you had a $150,000 annuity and you 1035 it over, you could use a portion of it to fund the base policy and a portion of it tax-free to pay for the rider all in one lump sum. And we see that a lot, especially with that target market typically of 70 to 85-year-olds. Because a lot of times at that point in their life, they know that money is earmarked for that emergency, and they know they're not going to use it for anything else. So reallocating a lump sum to pay it all up at once is pretty appealing to them, especially tax-free. And especially 70, 85, you typically don't want to add an additional income, an additional expense in retirement, because they probably did their retirement planning many, many years ago. Now, from an underwriting standpoint, you could do just the base policy by itself. So if you just want the tax-free play and you don't want to do the leveraging play per se, you could do the base policy by itself. Underwriting standpoint, you just have to be able to answer no to 4 knockout health questions, and then you could get the base policy. Now, if you want to add on either of the 2 riders to create that additional leveraging play, then there's an additional health questions and phone interview that's going to test you cognitively. Now, one thing I always like to point out is I'm a huge believer in lifetime benefits, and I know the industry from a long-term care standpoint isn't really that way. And I always like to be kind of blunt about it. So in my opinion, when you talk long-term care, it's funny, people always talk about, well, I don't want to solve for the catastrophic risk. I want to solve for that 2 to 4 year type claim. And I always kind of laugh at that because at the end of the day, that 2 to 4 year type claim, that doesn't take the catastrophic risk off of the client. And at the end of the day, that's why insurance companies exist. If I buy my homeowner's insurance, I purchase insurance to cover my, complete loss of my house, whether it be a fire, tornado, whatever it may be. I don't cover it for petty theft and not cover it for a catastrophic burning down of my house. Same thing with medical insurance. I don't cover like small ER visits and not cover cancer. If anything, I'm going to do the opposite and do a high deductible plan where I take on some of the smaller risk myself and shift things like cancer to the insurance company. So that's that same concept, that the way people buy, especially affluent people, the way they buy insurance is they buy a high deductible plan. Because at the end of the day, they want to put the catastrophic risk on an insurance company, but they want to do it at a more affordable rate. So making a high deductible plan, they take on a little bit more of the risk on the short term. That way they can get their catastrophic insurance coverage at a much more affordable rate and at a fixed cost. That's what we're doing here. So we're just taking that concept of a high deductible catastrophic policy insurance wise. We're taking that same concept that they do with other types of insurance and doing it with long-term care. The really cool part is when you're spending down your deductible or that base annuity, you can spend it down tax-free, assuming it's non-qualified. Now, if you were to do an annual pay rider, another thing I always like to point out, the premiums are fixed, so they can never go up in price. And also, you can use HSA dollars to pay for the rider each year if you're paying it annually. So if you've got a client with a lot of HSA dollars built up over their working years, or is maybe still working and still contributing to an HSA, you can use HSA dollars tax-free to help pay for the rider, since the rider is filed as a traditional long-term care policy. Same thing would also apply. You've got potential tax deductions for paying the rider premium annually as well. So just something to keep in mind depending on whether you're doing annual pay rider or single pay riders. Now in 2010, when we knew the Pension Protection Act was coming into effect, we knew we could create an additional annuity care option that took even more advantages of it. So with Annuity Care 1, if you remember, the rider was optional, so you didn't have to do the rider. Well, Annuity Care 2, the rider is automatically included, and we changed the way it's funded. So with Annuity Care 1, you were doing either the annual premium for the rider, or you were doing a single premium towards the rider. On Annuity Care 2, we're going to take a small monthly BIP charge each month out of the annuity to pay for one of these three rider options. So now you will notice there's no lifetime option on Annuity Care 2. That's because we wanted to keep the monthly charges down. So Annuity Care 2, whenever you're trying to figure out, okay, what's the difference between Annuity Care 1 and 2? At the end of the day, it's two major things. It's Annuity Care 2, the rider's automatically included, whereas Annuity Care 1, it was optional. And on Annuity Care 2, the base policy over time pays for the rider, as opposed to Annuity Care 1, where you're paying either an annual premium out of pocket or allocating a lump sum towards the rider. So that's why the two products exist. We initially couldn't design Annuity Care 1 back before the PPA existed. We couldn't design it to pay for the rider tax-free over time. So it wasn't until the PPA came into effect that we could build a product like this. So that's an easy way to kind of remember, which came first and why they're different. Now, some people like to look at things as a leveraging play. So while the riders are either 3 years, 6 years, or 9 years as far as your rider options, if you like to look at it from a leveraging play, you're basically either leveraging your money 2.5 times, 4 times, or 5.5 times, depending on which rider option you choose. So if I put $100,000 in my base annuity, I can either make it worth $250,000, $400,000, or $550,000 tax-free for long-term care use. Now, I do get the question a lot of, well, why wouldn't you just always do the biggest leveraging opportunity? And there's two reasons you may not. It's really a personal preference thing in some ways. So it may be dependent on their age. Obviously, the bigger the rider you do, the more costs coming out of the base annuity to pay for it. So, maybe I don't want as much cost coming out because I want to see better cash value projections on my annuity. So maybe that's why maybe I don't do, a 5.5 times leveraging as opposed to doing 2.5 or 4 times. Also, the other thing that comes into play is they are age-based. So I can get the 2.5 times all the way through age 70, or I'm sorry, all the way through age 80. I can do 4 times leveraging all the way through age 75, and I can do 5.5 times leveraging all the way through age 70. So you could be in a situation where at 75, I can't do the 5.5 times option, but I could do 4 and 2.5. Now, me personally, I don't care what's happening to the cash value of the annuity, so I'm always going to go as long as possible. I'm always trying to put as much of the risk of a catastrophic type situation on an insurance company. But the nice thing is you can kind of play and give and take with it. Now, from an underwriting standpoint on this product, because the rider is always included, there's always going to be a phone interview with this product. So whereas Annuity Care 1, you could have done just the base only and only had to answer no to 4 knockout health questions. Here, because the rider is always included, you're always going to be doing a phone interview. Now, in 2014, we wanted to come out with an additional annuity care option because we were hearing from people that, hey, I like the concept of Annuity Care 1 and 2, but they're fixed annuities, and I'd like a little bit more potential cash value growth from my base annuity. So in 2014, we introduced indexed annuity care. And indexed annuity care works a lot like Annuity Care 1. So once again, the rider is going to be optional. And once again, we're going to bring lifetime back as an option. And the way you pay for the rider, once again, will either be with an annual premium out of pocket or a lump sum. So Annuity Care 2 is the only option where the base policy actually funds the rider portion of the policy. Everything else, the rider is optional, and it's funded either with ongoing premiums or a lump sum. So just like Annuity Care 1, you could do the base indexed annuity by itself. Just have to answer no to those 4 knockout health questions. But once again, if you do add on the rider to create that additional leveraging, then there's going to be a phone interview again. Now you notice from a leveraging standpoint, you don't have to do lifetime. So you could do a rider that doubles your annuity's value or triples your annuity's value as well. If I put 100,000 in my base annuity, I can do a rider that makes the total value worth 200,000 for LTC, 300,000, or that infinite pool to cover the catastrophic risk. Now, as far as the base annuity, obviously we are using an index chassis on this, and we wanted to keep it fairly simple. We didn't want to overwhelm people with, this might sound ironic coming from us, but we didn't want to overwhelm people with a bunch of options. So we kept it simple as far as the indexing options. It's just 4 indexing options. There's annual point-to-point with a cap, annual point-to-point with a participation rate, monthly average with a cap, and monthly average with a participation rate. So you've got those 4 indexing options, and then you've got a 5th option, which is a fixed account. The 4 indexing options have a minimum guarantee interest rate of 0%, so you can't lose money, but if the S&P 500 was down that year, you might not actually gain any from a cash value standpoint. And then the fixed account, as of pre-July 15th, has a 1% minimum guarantee rate. However, on July 15th, that minimum guarantee rate is going up on indexed annuity care on the fixed account. Another cool little advantage that we added on to the indexed annuity, because you could have years where the cash value might grow none or 0, if you will, because the S&P 500 could be down that year, we still wanted to give you guaranteed growth of the base annuity from a long-term care perspective. So similar to how you might buy an index annuity or a variable annuity with an income rider, where you've got that, 2 ledger values, you've got the cash value, and then you've got your guaranteed step-ups for annuitization. And a lot of times on variable annuities or index annuities, it might be a certain percent. So you might have a guaranteed step-up of 5%, so that if your cash value wasn't doing well, you'd still have, if you annuitize, you'd still have growth on that value to annuitize it for. We took that same concept, but used it for long-term care. So every year, even if my cash value didn't gain anything that year because the S&P 500 was down, I'm still going to get guaranteed growth from the long-term care value of that base annuity, no matter what happened with the S&P 500. Now, we don't do a certain percentage. Instead, what we do is we use a multiplier. And there's actually 2 multipliers. I would definitely, if you have access to getting this through either your internal wholesaler or your marketer, a good page to really walk you through, or a good example of that, would be on page 6 of the client brochure for index annuity care. That's just kind of a nice page that gives you an example of growth over time from that guaranteed step up. But just keep in the back of your mind that base annuity does have guaranteed step ups from a long-term care value standpoint, and it's free of any charge. So there's no BIP charge to the annuity to pay for that step ups. That's just something that's free of charge. And the reason we're able to give that for free is because obviously we want to try and have people hold on to these annuities and keep them on the books with us. So it's just a way to help with our retention rate. So to kind of help convey the value of annuity care to your clients, we have updated our marketing materials for this campaign, and you can access them all from assetbasedltc.com. Once again, you will get a link in the email that's going to be sent out to everyone within the next 24 hours. You will get a link to that website and the marketing materials. But if you want to get kind of a preview, or if you're kind of multitasking right now, it's once again assetbasedltc.com, and then you'll see a link on there to go to the campaign landing page, and that's where you'll see a lot of our marketing materials, especially the ones that are specific to this campaign. Now, the things you'll see there, you'll see like the core brochure, and that's really to help you start the conversation with your clients and kind of describe the overall concept of annuity care. Now, for more details on the options to fund the protection, you'd want to refer to the Annuity Care and or the Annuity Care 2 funding option brochure. So the core brochure kind of talks about the annuity care portfolio as a whole, and then the Annuity Care 1, Annuity Care 2, and Index Annuity Care, they all have their separate client-approved funding brochures as well. So one is to help with that first initial conversation, and then the others are, once you've determined which product you want to present to the client, then you can go a specific brochure based on just that specific product. So it's kind of like a multi-step or multi-meeting approach that you can use those materials with. And in case you're not completely familiar with our marketing pieces, please keep in mind we have additional client-approved pieces that give more details on other policy features too. Like we've got a piece based on inflation protection. We've got one that's just kind of general insurance definitions, like things you would see in an outline of coverage. We've got a client-approved piece that kind of walks through a bunch of those things. Now, also, there is additional client-approved annuity care campaign materials that are available as well, and that'll be on the campaign landing page as well. And some of those things might be like, client mailers, invitations to seminars, some sales tools, some presentation pieces, some videos, and just a whole lot more. So there's a lot of things you can check out on that website. Once again, you'll get a link to that email to you, but if you want to get a preview before then, assetbasedltc.com, you'll see some marketing pieces on there, and then you'll also see a campaign landing page for pieces that were designed specifically for this campaign. Well, that's really it for today's webinar. I do want to thank everyone for attending. Also, if you are interested in joining our full product national webinar, we do actually a full product training where we also help try and set up the long-term care cell to make that conversation a little bit easier with clients. So if you're ever interested in attending our full product national webinar with that learning how to kind of speak with clients piece as well, feel free to email me and I can shoot you over a link that has a link to those webinars. We do that every other Friday at 11 a.m. Eastern. So you always know when the next one's going to be, and you can register for any of the dates with the same link. Once again, thanks everyone for attending, and have a great rest of your week.